Hello and welcome to Property Box Weekly News with me, Simon Evison. The spending review has been and gone. Let's look at how it affects investors. Firstly, there is a new stamp duty for buy-to-let purchases. There will now be a 3% surcharge on new buy-to-let purchases. From April 1st, 2016, investors will be charged higher rates of stamp duty land tax on purchases of properties valued above £40,000, such as buy-to-let properties and second homes. These higher rates will be 3% above the current stamp duty rates, but if you buy property valued at £40,000 or under, it will be 0%. Anything over that, and you pay the full 5%. The government are planning to consult on the policy detail, including on whether an exemption for corporates and funds owning more than 15 residential properties is appropriate. Other tax affected by the report is capital gains tax. Any new requirement for the capital gains tax due is that it must be paid within 30 days of completion and will come into force by April 2019, making paying this tax simpler and quicker for taxpayers.
It's going to kick the amateurs out. It's going to separate the men from the boys. Previously, pre-December 2014, it was actually paid stamp duty over 125,000 was actually paid as a percentage of the purchase price. So under the very old regime, if you were to buy a house for £275,000, your tax liability bill would be £8,250. So that works out to be 3%. Under the current regime we're in at the moment, if you were to buy another property for £275,000, you'd end up paying £3,750 because it's done on the sliding scale. That works out as a tax effective rate of 1.3%, so you'd be making a saving. Here the government was actually trying to encourage further property purchases, but as purchases started to surge, they started to realise most of them were actually going into the hands of landlords and not into the first-time buyers. So what they're doing now is, under the new regime that will start in April 2016, is if you were to buy another property for £275,000, your effective rate will be 8%, 3% above the current, which is £13,750. Now that sounds like a lot of money, but you know, the difference of a £10,000 difference from now to what it was before, it's only 5% of the purchase price. If that's going to kill your deal, it's probably not a good deal. So most of us investors that we know what we're doing, we can work around these things. They're trying to migrate it more to limited companies, purely they want to keep all the portfolios under one shelf.
Looking at benefits now, there will be a cap on the amount of rent that housing benefit will cover in the social sector relevant to the local housing allowance, which is the rate paid to private renters on housing benefit. Plus, anyone who receives housing benefit and goes abroad for more than 4 weeks at a time will no longer have their rent paid. That's all from me this time. Thanks for tuning in. We'll see you next time on any disposable residential. And it's looking at benefits now. No. Capital gains tax, Grenville. Any disposable residential property, simpler and quicker for taxpayers. That didn't work.